Welcome to the deep dive. Today, we're looking beyond the usual suspects like mutual funds and ETFs.
Right.
We're on a mission, really, to uncover some unique investment vehicles, tools designed for very specific needs.
Exactly. And while, they share common ground with mutual funds, pooled money, professional managers, each one we'll discuss has its own distinct features.
Tailored solutions.
Tailored solutions, precisely, built for particular situations.
Okay, so let's kick things off with segregated funds. Now, these look a bit like mutual funds, right? Pooled investments.
On the surface, yes.
But the twist is they're actually considered insurance products. Let's unpack that. What does that mean for an investor?
Well, it unlocks some really interesting features because they're insurance contracts. First up, you've got maturity guarantees.
Okay.
This means there's a promise you'll get back at least a portion, say 75%, often even up to 100% of what you put in over a 10-year term, or if the annuitant passes away.
Annuitant being the person whose life the contract is based on.
Correct. And that leads to death benefits. Your beneficiaries are guaranteed to receive at least a certain amount, and often that payout is tax-free.
Now, I've heard they offer something especially useful for maybe business owners or entrepreneurs.
Ah, yes. Creditor protection. This is a big one.
How does that work?
Because the assets are technically owned by the insurance company, not you directly. They can be shielded from creditors if you face personal bankruptcy. Of course, there are caveats. You need to have bought the policy in good faith, not to deliberately avoid creditors. But for someone facing potential liability, like an entrepreneur,
Yeah, that could be a really strategic move. Peace of mind.
definitely, it lowers that personal asset risk.
And I think there's an estate planning angle too.
Absolutely. Probate bypass,
Meaning,
meaning the money goes straight to your named beneficiaries. It skips the whole probate court process, which can be slow, public, and, frankly, expensive.
okay, and regulation-wise, these aren't like mutual funds.
No, that's key. They fall under provincial insurance regulators, not securities commissions. And there's a serious protection limited, mind you, if the insurance company itself fails, up to $60K or 85% of guarantees.
Got it. What about taxes? Any unique aspects there?
Yeah, they're generally taxed like trusts, but interestingly, capital losses can actually flow through to you, the contract holder.
Oh, unlike mutual funds where they usually stay within the fund.
Exactly. That's a notable difference.
Okay, so seg funds offer a sort of safety net with investment potential. Let's pivot now to something, well, maybe higher on the risk scale.
Uh-huh.
Labor-sponsored venture capital corporations, LSVCCs. What's the story here?
Right. These are funds often backed by labor unions funneling money into small, medium, and startup businesses.
Okay, venture capital, essentially. What's the main attraction?
It's almost entirely about the tax credits. They can be quite significant.
How significant?
You're looking at a 15% federal credit, plus potentially a provincial one some provinces offer up to, say, 17.5%.
Wow. So quick math, a $5,000 investment could mean
Could mean $1,500 back in your pocket via tax credits, depending on your province. Pretty substantial upfront benefit.
that sounds amazing. So what's the catch? There's always a catch.
Yeah. Yes, there usually is. And here, it's risk. Big time.
High risk.
Very high risk. These are speculative investments. You're backing startups, emerging companies. Many just don't make it past the first few years. Statistically, failure rates are high.
Okay, so not for the faint of heart. Or your emergency fund.
Definitely not. Plus, there's a holding period. You typically need to keep the shares for 8 years
8 years. Why?
to avoid having to pay back those tax credits you received. So it's also quite illiquid.
Right. High risk, illiquid, but potentially high reward through those credits.
Right.
Got it. Okay, one more category. Closed-end funds. These are pooled funds, too, but they issue a fixed number of shares, right? And those shares trade on an exchange.
Exactly like regular stocks.
Yeah.
They raise capital initially, sell those shares, and that's it. No more shares are issued by the fund, and they don't redeem shares daily like mutual funds.
So what's the interesting part about how they trade?
Well, what's fascinating is that their market price can drift away from their net asset value per share, the NAVPS, meaning the fund might hold assets worth $10 per share, but the shares might trade on the stock market for $9 or maybe $11.
A discount or a premium? Why does that happen?
Simple supply and demand in the market for those specific shares. Maybe the fund holds unpopular assets temporarily, or maybe investors just aren't excited about it at that moment.
So a big discount could be like a buying opportunity?
Potentially, yes. You could essentially be buying the underlying assets for less than they're worth. It requires research, of course.
And does that fixed number of shares give the managers any advantages?
It does. They don't have to worry about daily inflows and outflows like open-end mutual fund managers.
No forced selling to meet redemptions.
Precisely. That gives them more flexibility for long-term investing strategies, and sometimes it can lead to lower operating costs, maybe a lower MER, compared to similar open-end funds.
Okay, so summing up, we've got segregated funds with their insurance features, LSVCCs with those big tax credits but high risk, and closed-end funds trading potentially at discounts. Quite a diverse bunch.
It really shows how the investment world offers tools beyond the mainstream, each designed to solve a specific problem or meet a particular need, whether it's protection, tax efficiency, or accessing unique market dynamics.
So understanding these other products really expands your toolkit.
It absolutely does.
Yeah.
If you connect this to the bigger picture, knowing about these structures helps you tailor your approach. You might unlock opportunities or find protections you just didn't realize were out there.
Which leaves us with a question for you, the listener.
Yeah, how might understanding these niche products, these different ways of structuring investments, actually reshape how you think about the more traditional options? And maybe, just maybe, inspire you to look a bit deeper for solutions that fit your specific financial goals.